Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice. Hi, everyone, and welcome to the Stock Spinoff Investing Podcast. I'm your host, Rich Howe, and today I'm excited to have Ron.Nussbaum of Maverick Value on the podcast. Ron, thanks for joining.
Thanks for having me, Rich. Um, so a little bit about me. I grew up in Orange County in Huntington Beach. Went to college at UC Santa Barbara, studied business economics and accounting. And then I worked for a year in investment banking at B of A Merrill Lynch, working on tech companies. And that was very interesting because looking back, some of those companies were small caps by definition today, but now today they'd be considered mega caps. And just interesting how things have changed. A year after being at Merrill Lynch, I left to go work at Wells Fargo's middle market M&A investment banking group in Charlotte. Wanted to get more of a technical experience rather than just sort of the industry background. And then after a year at Wells Fargo, completed my 2-year investment banking program and wanted to go out and start my own investment management company. It's something that I've been interested in my whole life, I think since I was 13. Had always been interested in the stock market, got kind of into it during the dot-com bubble and the crash, and just always been following it, and it's something I've always wanted to do. So I've been managing money ever since, and then officially formed Maverick Value in 2014, I believe July 2014, so about 12 years. And we manage about $20 million in assets today. And we focus primarily on small cap, deep values, but this podcast, especially, some of my holdings are larger companies as well, and Comcast is one of them. And happy to take it from there.
Yeah, great background. A couple follow-ups. So you grew up in California and you did investment banking. Initially, was that on the West Coast for your first year at Merrill?
Yeah, first year was in Palo Alto in their
Yep.
tech group.
And then you did a couple years in Charlotte, so you moved cross country?
Yeah.
Yep. Very cool. Well, yeah, Ron, it's good to have you on the podcast. We've, interacted. We talk about, or I guess we look at similar stocks, whether it's micro caps or special situations. We've been like exchanging DMs on Twitter for a long time. We finally met in person, I think in Berkshire a couple years ago, which was fun. And then, ever since we've been kind of, exchanging texts once in a while to compare ideas, exchange thoughts on special situations and spinoffs. And so when you mentioned that you are interested in, or that you like Comcast, I thought it was a perfect example to get you on the podcast to talk about the thesis. I guess before we dig into the Comcast thesis, I'd love to hear a little bit more about how you approach managing a portfolio. So like, as far as I understand it, you manage separately managed accounts for folks. Do you have like, is it like a pretty highly concentrated portfolio? Do you have 10 names, 20 names? Like how do you think of, I guess, concentration and constructing a portfolio? Does everybody have the same portfolio generally?
Yeah, so the portfolios are nearly identical, plus or minus, few differences for tax purposes, but for the most part, they're managed exactly the same weightings. And in terms of portfolio management, and that's something I've focused a lot on, I would say the last 5 years, especially. My top position size would be 10% at cost. And I say at cost because, the stock falls 50% and it becomes a 5% position. I don't add to it another 5% and make it 10% because that would add another 15% at cost. So I try to cap it at 10%. And that just keeps me kind of grounded, doesn't let me get too emotional if the stock works the other way, and lets me hang on, because as cheap as you think things might get, they can get even cheaper. And in my portfolio today, I'd say about 25 to 30 names. And they range from, like I said, 10% at cost to maybe a quarter of a percent. And smaller positions are things that I'm interested in, but still have a lot more work to do on them. And either I'll add to those or I'll get out of them, or maybe they're just fine, kind of sized the way they are based off the risk reward profile. But that's, yeah, typically how I like to do that. And it's definitely helped me out a lot, versus, historically sort of uber concentration. I think this is a good approach and worked out well.
Hey, so two follow-up questions. One, has your investment approach changed over time? Me personally, I've gotten less concentrated over time. I used to think, hey, Joel Greenblatt, he puts all his money in a couple names. I'm going to do that. Why do you have to have money in your fifth or sixth best idea? I've learned to appreciate that I can be wrong sometimes, and I've learned to appreciate the benefit of diversification. So I'm just curious, has your investment approach changed over time? And then also, when do you sell? So 10% max at cost. Say you put 10% in a high conviction idea, it kind of goes through the roof. How do you kind of manage risk to the upside while also benefiting from the good performance of your high conviction idea?
No, those are great questions. It has, and that goes back to the portfolio weighting. It was something, kind of like what you said about Joel Greenblatt, putting, your five best ideas, why add to the six sort of thing. That's sort of initially how I approached it, and it worked out fine. It's just that, things can stay cheap for a while, and there's so many other companies out there. If you're only finding, a handful of companies, you got to be sure that those are the most undervalued, best ideas with the, highest near-term upside. And I just don't think that's likely. When you have a broader portfolio that's still concentrated, you could still have that focus, still know your companies well, but at the same time, kind of gives you liquidity. Just some things, some stocks work out much better than you expected and also earlier than you expected. And you can use that and rotate into other things rather than being kind of jammed with a handful of companies that, could all be trading down or sideways or kind of lagging the market. This approach just helps, and yeah, it's worked out well for me. And then in terms of selling and trimming, yeah, that I don't have like I can't say like a scientific or like definitive answer. It really is, if as it goes up, unless anything changed and made the company more valuable, I do find it less attractive and I will trim, and I'll sell very small amounts, like not even less than half a percent, less than a quarter percent as it goes up. And I'll either hold cash or put it into other ideas that I have a smaller weighting or that are more attractive. So I'm
That
definitely
makes
not
yeah,
holding.
that makes complete sense. I mean, it's like outliers are going to drive your performance. So like you have to let those outliers the investment case play out. And oftentimes just like valuations can go way below your downside case, valuations can go way above your upside case too. So it's kind of nice to be able to like maintain some exposure to like the upside case and catch in the event that you kind of catch a tiger, by the tail and you're along for the ride.
Yeah, yeah. So I manage how the size of each position as it's changing within the kind of rest of the portfolio and its weighting. So
Do
there,
you have a set limit for how big a position can get? Like at 20%, will you trim? Is 20 like your max position size, or is there any position limits, or is it all just based on the individual situation?
yeah. So 10% at cost, and usually it's because the stock has fallen, so it won't be 10% of the portfolio. But yeah, I like to also keep it at 10% of the market value. And
Mm-hmm. Mm-hmm.
I know that might not sit well with some people. It just for me, it works out well. And I haven't had a stock that really just kind of blew all of a sudden that became a 15% position.
Mm-hmm.
Um, so I'll usually trim as it, crosses 10%. Um, not like super methodically, but I try to keep it around, not more than 10%. And just, um, it just works because there's other ideas that I have, and, that I can look at and kind of grow. And hopefully those will continue.
That makes sense. And 10% is a big position for like a normal fund, right? So
Yeah.
it's not like you're being a chicken or anything with a
Yeah.
10% position size. Yeah, I listened to a podcast with like Gavin Baker. He's been on a bunch of podcasts, and one thing that he said was like the best position size is one that allows you to be rational when you're wrong. And I found early in my investing career, I would have position sizes that were just too big. And I would just be thinking about them all the time and just not thinking about them in like a rational way. So I think it's like there's a lot of ways to make money, right? Like Peter Lynch owned thousands of names. Warren Buffett was highly concentrated at one point. So was Joel Greenblatt, and so lot of different ways to make money. Um, let's pivot and talk a little bit about Comcast. So I've done a little
Sure.
work on Comcast because obviously I cover spinoffs, and they recently announced their second spinoff. They've completed one spinoff already. So I like where this is headed. But I would love for you to walk me through your Comcast investment case and why you think it's interesting.
Sure. So, initially I got interested in the Comcast thesis towards, I guess, the end of last year. Um, Basically, I saw where Charter was trading at, and I think at the time they were around 6 times EBITDA. They had just made an, or they announced a few months before that they were acquiring Cox Communications for 6.5 times EBITDA. And I realized Comcast was trading at like 5 times EBITDA. Plus, they had, NBC Universal, the theme parks, studios, and those, if you look at even Paramount Sky, traded at a much higher valuation multiple. So to me, it just didn't make sense that Comcast traded at a lower multiple than Charter, even though it had, this other business that was definitely a higher multiple business. And then also you can argue why the broadband business deserves a higher multiple. It seems like since then the valuations have converged. So now they both trade at around 5 times EBITDA. Um, but still, it doesn't, you're not getting much credit for the NBC Universal theme parks division. And I think that valuation for just the broadband business alone is too cheap, regardless of how cheap Charter is. I think doesn't Comcast broadband the highly cash generative business, it shouldn't trade. I don't think it should trade at such a low multiple. Um, and so yeah, it seems like the thesis, or at least my initial thesis, is starting to play out in the sense that Comcast has announced the spin, which would help uh, basically realize that valuation, the ability to monetize the NBC Universal stake and actually do it tax free. Um, I'm a little surprised that the stock hasn't really responded positively, maybe initially, but then it sort of kind of came back down.
Yeah, we're recording this on July 14th. So Comcast announced the spinoff. The stock popped like 20 or 25% and then gave it almost all back. So I think it finished maybe up 3 or 4 or 5% on the day, but it definitely didn't hang on to its gain. So this situation is like what I like to call like a demerger arbitrage situation where or a math exercise where you do the math and you get an estimate of what you think each part of the business is worth, and then you know that the spinoff is going to take place within a year. Maybe it doesn't, maybe it gets canceled, but like I'd say very high odds that this takes place, and you basically should have a situation where value is unlocked. So walk me through how you're thinking about value. Like, how do you value? I know the Form 10 has not been published. The financials from 2025 still include a Versant, which is another spinoff, and so it's a little tricky to get super detailed in terms of the numbers. But like at a high level, how are you thinking about potential valuation for the spinoff and for RemainCo, and how does it compare to the current share price?
Yeah. So I think it might help your listeners just kind of at least get my thoughts on like why I think they took pursued the spinoff. If you start backwards, you know, the valuation, the EV to EBITDA has never been so low for Comcast, at least since I've checked, and even in 2008. Um, and they Comcast likely realized when during the bidding war for Warner Brothers when Netflix, made an offer, pretty high offer, I think like 3 billion, and then you know, Paramount Sky topped that, like over 100 billion. They realized, and they were also participating in the bidding war, and they try to use, I think, NBC as currency to issue stock to make an acquisition. They realized they were sort of limited there, and I think they realized, hey, this business is getting a really high multiple. Meanwhile, our Comcast has never traded so low, and then the gap between the broadband business and the media business is just as great as it's ever been. And from my standpoint, I think they may have realized, why we're paying our dividend yield is like 5.5%. I think even more now today. And yet they don't need to pay a dividend for the NBC Universal business, because investors would view that anyways as a growth vehicle, and they're not really owning it for a dividend. Whereas, and so the current dividend that they're paying is basically covers the entire company, but they could, if they kept that same dividend amount, they could realize a much higher yield, just through Comcast, for the RemainCo, or they can cut the dividend dollars amount that they're paying and then kind of maintain the dividend yield that they had, previously. Um, and when you look at the valuation, if you take yeah, it's like you said, a little complicated because the Form 10 isn't out, but I get something around like 28 to 29 billion of EBITDA for the kind of legacy Comcast, the RemainCo, which is the broadband side. And if you value that at just 5 times EBITDA, you're getting like 140 billion plus, enterprise value. And this isn't sort of breaking out the residential versus business services. And you can argue why business services deserves a higher multiple, but for now, you just slap a charter kind of multiple on that 5 times, you get 143 billion enterprise value. Today the entire enterprise value is 170 billion. Um, you know, that's like the last time I checked. So, the implied valuation for NBCU is very, very low. Um, and within NBC Universal, you have, the crown jewels, the theme parks business generates or to generate around 4 billion of EBITDA this year. It's growing pretty fast. They just um, spent billions of dollars on Epic, and they still have other theme parks that they're working on, like in the UK. But based off how those businesses are valued, you could argue that deserves a 10x multiple. So you'd get 40 billion valuation for the theme parks. They're putting their Sky business with NBC Universal, and they don't provide a breakout specifically for EBITDA, but the last time they had it, I think it was 2.5 billion of EBITDA in 2023, and if you kind of revenue has actually kind of maintained, kind of actually grown a little bit since then. But if you just take a $2 billion EBITDA and call it 5 times EBITDA, that's another $10 billion valuation. And then the hard part is really what do you value the media and the studios business at? And one way you could look at what did Netflix, when Netflix made their offer, they were just buying the media and studios business of Warner Brothers. They weren't buying the declining cable networks, which Person also spun off. And I think they paid $3 billion for it. Now, the EBITDA for the studios business for the last 12 months, they have about 1.3 billion. Um, it's kind of difficult to get like a pure normalized number, also because of just the way the accounting works with the content amortization and just sort of what they're licensing and between their other segments. Um, but you could get just combined if you combine the media and studios business and just put 30 billion on that. Um, and you take out $10 billion capitalized corporate nations, that's a $70 billion valuation for the, studios, media, theme parks, and Sky. And, I think that's just pretty reasonable. Um, just more as a trading once they start trading. And, there's also the upside, after a few years, someone can make a bid for them.
Yeah, or a bid could happen before the spinoff takes place, right?
It yeah, it could. I think, well, the tax consequences, I think Comcast would want them to compensate them for the taxes that they would incur.
Mhm.
But yeah, I think that goes to why they said on the call, like, this is absolutely not, for to pursue a transaction. And I think they sort of had to say that. Otherwise, the IRS might be a little questioning their motivations.
Right, got it. Okay. And so there would be, if they did sell NBC Universal, there would be a big tax bill.
Yeah, I mean, I don't know exactly, but I would imagine that the cost basis is pretty low, with the amortization and how it works. But yeah, I would assume so.
Got it. Okay. So you said, I think if I'm following correctly, you said roughly 140 billion of enterprise value for RemainCo, roughly 70 billion in value for the spinoff. So what does that get you to, like 210 billion enterprise value, kind of on a sum of the parts
Yeah,
basis?
yeah,
And
yeah.
then what's the implied equity value for that?
So they have about 85 billion of net debt.
Hmm.
So that's about like 128 billion of equity, and that comes out to about $36 a share.
$36 a share. And as of we're recording this on July 14th, Comcast is trading what? 24 bucks?
Yeah,
23, 24 bucks. So basically over 50% upside, you think, kind of into the spinoff, with reasonable to conservative assumptions.
yeah. Yeah,
Got it.
exactly. I mean, the 5 times EBITDA for broadband, if you just change that, let's say you just change it all to 5.5 times, it has a big impact on the valuation. I think that gets you to like $40 a share just from going from 5 to 5.5 times for the broadband. But it also can go the other way too. You go from five
Right,
to four.
exactly. One thing that you mentioned that I hadn't thought about in this situation is the dividend aspect of it. And I think this is kind of fascinating. Like one of the key trades and setups that I kind of look for is what I call it, like the dividend as a catalyst trade. And this is one of the reasons why I liked Sunrise or Liberty Global, because they basically announced a couple years ago, they announced that they're going to be spinning off Sunrise Communications, which was their Swiss telecom provider, and they announced the dividend yield that spinoff was going to pay. And you could just back into an implied dividend yield, and it's super simplistic, but like you'd be amazed at how much this works. People really anchor to dividends because it's a hard and fast number, and you can compare it to the other peers in the market. And so it was very easy for me to back into an implied equity value for Sunrise, even using a conservative dividend yield, and then you would value the RemainCo Liberty Global, and you could get. It was clear to me that there was going to be some valuation, unlock. That's happened, so valuation has unlocked. It hasn't been a home run, but they're going to do the same thing. They're going to spin off Ziggo Group, which is another telecom business. This time they're Belgium Netherlands business, and they're going to do the same thing. They're going to say they're going to pay a dividend. And it's going to force investors to value it on a dividend yield basis. What has so have they shared at all how they're thinking about the dividend? Like, did they share anything about that on the call? was this is this just you kind of thinking about it, or were other analysts thinking about it too? Kind of is the because I guess the risk is that they could theoretically pay the same dividend for just RemainCo, but they also could cut the dividend and delever or make acquisitions. So I'm curious to kind of dig into the dividend dynamic a little bit to see what you're thinking there.
Sure. Yeah, so as far as I'm aware, they haven't mentioned anything about that, and I haven't seen anywhere mentioned via analyst reports. So yeah, I can't comment on that specifically, but I haven't seen anything. It just made the most sense to me because you look at the comparables, like Paramount, Sky. I mean, they pay like a small dividend, and Warner Brothers didn't pay a dividend, and I just don't.
Lionsgate doesn't pay a dividend.
Lionsgate doesn't. So I just don't think that, just if you start with the premise of they want to they want to obtain a higher valuation, and if they sold NBC, they would pay taxes on it. And if you're thinking, what's the best way we can, monetize our stake and get a higher valuation? Well, spin it off, okay, and then does NBC Universal need to pay a 5.5% dividend yield? Does it need to pay any dividend? I just don't think the owners of that's what they really want. I'd imagine people think it could be an M&A target at some point. So that could be one reason to hold it. Maybe it's a growth vehicle to make other acquisitions, and they see that them consolidating, or just naturally just EBITDA and free cash flow growth. So I don't think for the NBCU business, they would care about that. And then if you think about like, the broadband side, it's not really a growth vehicle. They're just harvesting cash flows, paying down debt, and you compare it to, let's say, Verizon, AT&T, or even, you know, Comcast as it is before the spinoff, those pay, 5% plus dividend yields. So, what's a way to make this business attractive? Um, pay a decent dividend yield, pay maybe 7%, 8%. Technically, they could pay like 10%, and they wouldn't have to raise the nominal dividend that they were paying before. But maybe you run into the issue of people viewing the higher the dividend yield gets above a certain point, maybe they start actually assigning a lower valuation to the company, because they start worrying about it. I don't know. Um, you know, they start seeing the high dividends, thinking there's even more risk. Um,
Yeah, that no, that's fascinating. I mean, I think that's a really interesting angle, and I think that is if they clarify that, I mean, I think that would be a hard catalyst because I actually think if they maintain the same dividend and just said, hey, we're going to spin off, like the spin-off is not going to pay dividend, it's going to just attract different quality of investors. I think that would actually be very interesting and very smart, and would be a really nice key catalyst, which would force, I think, RemainCo to get valued at a reasonable valuation. Well, the one thing
yeah,
that I struggle with this situation is that there's, and you could correct me if I'm wrong, but as I understand it, a lot of spinoffs, there's like a good co and a bad co. And in this situation, I'd say the spinoff is considered the good co, but it has some quote unquote bad assets attributed to it. So the studio business and the theme park business are considered the crown jewel, but then the media business and Sky aren't considered very good assets and on their own would probably trade at pretty low EV to EBITDA multiples. Is that the right way to think about those two businesses, or am I punishing them unfairly? Because the way that I'm valuing this spinoff is the same way you are, which is the sum of the parts. And from my perspective, it's never a good idea when you need to value a spinoff on a sum of the parts. Like the spinoff should unlock the sum of the parts. You shouldn't have to do another sum of the parts to value the new spinoff. So how are you thinking about the spinoff? Like is that media and Sky business, not a very good business that deserves to kind of drag the blended multiple down for the spinoff.
Yeah. So I'm not super well versed with Sky in particular, but it does well, it's not the best business. It seems relatively stable, so you could, it generates free cash flow, could support, the CapEx that the studio or that the theme parks business needs. It could, you know, help pay down the debt that they take on with the spin. Um, so I agree it's not the best business, and yeah, maybe doesn't deserve the highest multiple, but it's steady, I'm sure generates decent free cash flow. Um, so you lump up some growth businesses and some theme parks, which generates good EBITDA, but also takes up some CapEx. This provides some free cash flow stability. But I don't know what they're thinking particularly. Maybe they want to spin it off in the future. I also found it interesting that it was previously in the connectivity business, and now they're selling it with the media, the theme parks. Um, but I don't know. Perhaps they want to create an international division with their Telemundo business and then sort of
Yeah,
sell that
perhaps
off.
they're going to keep spinning stuff off, right?
Yeah,
Like honestly, because they already spun off Versant, and they're doing the next spinoff. They could just keep doing it, and sometimes that's a really good setup too. And even like kind of to your point, like even if you assume that I've kind of assumed the media and the Sky business trades at like kind of like Versant type multiples, like 4 times, Sky trades at 5 times because I think it is a little bit more stable. I still get to like a $32 kind of sum of the parts price target. So like I think even if you're very conservative, you can still get very good upside from where it's currently trading. What about the RemainCo? So as I understand it, and I'm not an expert by any means, is that the RemainCo has that's the connectivity business. So as I understand that, that's kind of like internet, and then they also have like a business services. And what I understand is that that's kind of internet, but for businesses. Is that the right way to think about the RemainCo?
yeah. Like think about like restaurants or just sort of any business. Yeah, they're not as a business. You're not looking for the cheapest provider. You're looking for the one that's not gonna uh, kind of have a shutdown or have any issues, because that would really have a big impact on your business. So it tends to be more sticky.
Right,
Yeah.
right. That makes complete sense. And then as I understand it, like the best comp for that business is Charter, and Charter I think trades at 5 times EBITDA or so. But from what I understand, Charter has less business services revenue as or percentage of EBITDA than Comcast RemainCo. So arguably, Comcast RemainCo should trade at a premium to Charter, but you can just assume that it trades in line with Charter to be conservative in terms of your valuation. Is that kind of the right way to think about it?
Yeah. I don't know the split on the EBITDA part. So my apologies on that, but
Got it.
I
No,
don't know
no
if the
worries.
margins, I guess, are lower with Charter. Um,
Yep. Okay. This is great. Is this a 10% at cost position for you?
it was, yeah, it
It
is,
was.
yeah.
Yep. Yep.
I mean, now the market value, it's probably like a 6.5%, just
Yep.
because things have gone up or this has gone down. So,
But this is a
yeah,
high conviction idea for you.
definitely. I
Yep.
mean, I personally would add if I could, but I like to, try to stick to my
Stay disciplined. No, I like that.
discipline,
What
but it's
about
tougher.
what about the risks? Like, are there any risks that you see? Like, what are the biggest risks, or what are the things that you're going to be kind of monitoring as this transaction takes place?
Biggest risk would be just overpaying for M&A. So the other risk would be with the broadband side, where the customer decline, churn increases, and then ARPU increases as well. ARPU decline increases as well. That's definitely not positive. It's also, I have that baked in, sort of 5% decrease every year, but it could accelerate. I don't think it will. Um, and yeah, I forgot to mention the wireless business as well, but that's actually I think a huge advantage that they have that is also underappreciated by the market. But yeah, you could get into sort of a battle with Verizon or AT&T, competing with against fiber, and sort of there becomes a price war, just for those guys to recoup their costs, and it sort of pushes prices down. So I would say that those are the biggest risks, um, that I can think of. Of course, there could be others as well, but I think those are the biggest risks.
How do you evaluate the risk I think another risk could be that like the spinoff doesn't happen. It seems like they're pretty committed. I don't see why they wouldn't be able to make it happen, but how do what are your thoughts on that? Do you think the spinoff takes place? I think the guidance is like, within 12 months, they're gonna complete the transaction.
Yeah, I think the spinoff will take place. It doesn't seem the businesses aren't so intertwined that you can't break them up. There actually doesn't seem to be sort of a reason why they're even together. I think if they don't spin off, perhaps it could be because they got an offer to be acquired, that they didn't, weren't planning for. So I'd view that more positively. Um, if they decided for some reason just not to spin off and there was no acquisition, I would be worried. Um, I'd be more worried for sure, because that could mean something went wrong and there's maybe some underlying issues. I personally don't see that happening, but yeah, that's always something that could happen.
Okay. Yeah,
Um,
that's great. All right. Well, that's pretty much I've kind of run through all my questions on Comcast, so this was extremely helpful for me. I agree, it looks undervalued. I have not bought it yet, but I think it looks very attractive. I'm going to be watching it closely. Anything else that you would highlight about Comcast before we kind of wrap up?
sure. Yeah, so with the spinoff there, I sort of have an estimate of them spinning, or NBC Universal taking on like 15 to 20 billion of debt, from Comcast. So that would reduce the net debt that Comcast RemainCo would have. And then because they're retaining a 20% stake about, that's another, let's say, maybe 10 billion that stays with, a value that Comcast can monetize and pay down their debt. So their net debt, Comcast, their main co's net debt can come down by like 25 billion or so, bringing it down to 60 billion. And, they have right now a pretty good debt maturity schedule. And, they have a lot of debt trading below par. I think like 79 to 80% of, is the market value relative to par. So, they could pay down a lot of their near-term maturities with that 25 billion and kind of push out their maturity to 20 years, and then reduce their weighted average interest rate. And I don't think the debt is as bad as people might think. Not all 85 billion or so of debt is the same. Depends on the maturity schedule, and they have a pretty amazing schedule. And they could pay a very competitive dividend yield, repurchase shares, increase the dividend per share that way, and then also pay down debt. And yeah, I think you might get a good multiple on Comcast broadband eventually too. So yeah, I think it's pretty attractive, especially at today's price. And I think today's price implies very little, if anything, for NBC Universal.
I love it. I love it. Great pitch, great last emphasis on the debt. I think that's great. And as they pay down debt, that reduces interest expense, increases free cash flow. So it's a really, really good story. Yeah, and I was looking at the COIFIN charts for the percentile. I don't know if you were looking at COIFIN or where you were looking at percentile, but my favorite ideas are ideas where it's really cheap on like a historical basis compared to the past 10 or 20 years, which Comcast is. It's in like the 1% or 2% of value, historical valuation based on where it's historically traded over the past 20 years. And then it's cheap on some of the parts, which we just did, right? And then it's also cheap just on an absolute basis, right? It's trading at, I think like 5 times or a little over 5 times EBITDA. So any way you look at it, it's cheap and it has a catalyst. where before we wrap up, I would love to just hear where, or if people want to get in touch with you to just connect, talk ideas, or learn about Maverick Value, how do you recommend they do that?
Sure. So I'd be happy to give my email. It's Ron.Nussbaum at maverickvalue.com. So my first name dot my last name at maverickvalue.com. And that's the best way to sort of reach out, actually.
Sounds great. And I will include that in the show notes as well.
Thank you.
Ron, thanks for taking some time today. I really appreciate you spending some time on the podcast, and I'm sure we will talk soon.
Thanks for having me, Rich.